Hello, everyone. Today on the final bar, we'll talk about the market overall in a choppy mode. Friday, we had acceleration to the upside going into the close. All eyes on the markets this week to see what happens, given all the potential catalysts to what we're seeing after the Fed meeting last week. Today is about choppiness, is about volatility of things like energy and financials really moving to the upside. On the other side, you have real estate, healthcare, utilities coming off, technology as well. Where does this net out for the S&P 500? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of stock charts, using technical analysis and the technical toolkit to try to make sense of investor psychology, supply and demand, fear and greed, all of those emotional drivers of investing decisions that net out into price action. And we've talked many times about the importance of focusing on price. What message do we get from the markets on a day like today? Well, Mondays are awesome because we start with the big picture. We're going to look at the chart of the S&P 500, look at how it's rotating around and really hugging, straddling the 50-day moving average, playing both sides of it. And we'll see which way that nets out and why that's an important guidepost to look for. We'll also look at some of the other asset classes quickly and see what themes we can tease out because higher rates are really the story driving things like financials to the upside, commodities and their renewed strength driving energy stocks even higher. Then we'll look at the individual sectors. We'll look at the 11 S&P sectors and where the opportunities may be. Then look at a bunch of individual stock charts, and that's how we'll finish off our 30-minute sprint through the market activity. Should be a lot of fun, and we'll get to it here in a moment. Couple quick announcements before we get started. We have some great guests on the show. We had a lot of fun last week with some of our fabulous guests, really thoughtful and knowledgeable experts. This week, more of the same. Tomorrow on the 28th, we have Alessio Ritigliano. He's the crypto expert over at Wyckoff Analytics coming to us from San Francisco. On Wednesday, the 29th, fund manager Dana Lyons of J. Lyons Fund Management and the Lions Share Report. Then on Thursday, the 30th, one of my mentors, Jeff Weiss, who's the technical analyst at Clearview Trading Advisors in New York. He taught me so much about being patient, about thinking about the long-term trends, focusing on long-term trend lines. And I think it'd be a great time to bring him on the show. Also, our latest episode of The Pitch is coming up tomorrow on Tuesday, the 28th, 5 p.m. Eastern. The Pitch is our monthly stock picking showdown. I'll be moderating a conversation with Tom Bowley from Earnings Beats, John Kosar from Asbury Research, and Joe Rabel from Rabel Stock Research. They will each have the opportunity to present 5 ideas to you. We'll discuss them as a group. You will leave that discussion with 15 tickers jotted on a piece of paper to dig into a little further. Go to stockcharts.com/the pitch for more info on that great show. Let's continue on with today's market recap. As I mentioned, this is sort of a choppy day. It netted out more on the downside. So the S&P was down just over 0.25%. But if you look at the 2-day little preview chart on your dashboard on stockcharts.com, you can see it was sort of a choppy day. We opened a little bit lower, traded right back up to Friday's close, but that was the peak of the day. From there, it was more about some short-term distribution. No real, distance lost on the downside. It was only 0.25%. The S&P closing just above 44.43. This is one of those days where the NASDAQ was actually lower. The Dow was actually positive on the day, and the S&P was there in the middle. We used to see a lot more days like that where it was sort of the barbell approach. Mid caps and small caps did just fine, and that's because of the sector movements today. Energy and financials really were the top performers, materials as well, and all three of those sectors are more strongly represented in the small cap and mid cap indexes than in the large cap, which is more dominated by things like technology, consumer communication services. The VIX, by the way, back higher today, just still below 19, but that's coming off of much lower level Friday going into the close. Interest rates are kind of all over the place today with the dollar sign TNX, the 10-year yield, spent a little bit of time early this morning above 1.5% for the first time since over the summer, actually, spring into the early summer months. Came back off and it ended the day just around 148. But again, this is elevated, a pretty big deal from where we've been at recently. We touched 111, 115 not too long ago, and now back 30 basis points higher up to just below 150. The UUP, the dollar index, is up just below above 25, rounding error from Friday, so not a lot of movement there. Commodities, you're certainly seeing a move to the upside. You saw the UNG, the natural gas ETF, up over 12% today. The USO, the crude oil ETF, up about 2%. It's interesting. If you missed our show last week, I think it was on Thursday's show. I might be wrong on that. We actually looked at the USO tracking oil. And if you look at it, a lot of times commodity ETFs will become disconnected from their underlying future, the commodity, because there has to be a lot of rolling over, adjusting that a commodity ETF needs to do to maintain the appropriate exposure to the commodity itself. And a lot of times the returns can become disconnected. The USO has actually tracked crude oil very, very well over year to date for sure. They're up over 50% year to date, almost tripling, over tripling the returns of the S&P 500 year to date. A lot of people did not know that the returns were that strong on crude oil. So when I see energy up again today, I'm thinking of that year to date return profile in my head. Cryptocurrencies all down a little bit, quite a choppy weekend. And I hope you saw, I think it was on Friday, we featured a chart of Ethereum and looking at Ether with a short term and hourly chart. And over the weekend, actually traded beautifully around those levels. If you missed it, I'll go back and check that out and bring up the chart of the hourly chart of Ethereum, and still sort of remaining in that range with Ethereum settling in around 3%. But all the cryptocurrencies, for the most part, down from where they were yesterday. Let's look at a chart of the S&P 500. So we spend a lot of time on this chart every day, or at least we revisit it. And again, I think one of my mentors, Ralph Acampora, always told me if you have one thing to understand the equity markets, to understand the performance of the S&P 500, make it a chart of the S&P 500. We can get cute, we can get creative, and look at all sorts of different breadth and sentiment measures, and look at a lot of individual names. But at the end of the day, do a thorough, consistent analysis of the S&P 500, and overall, you're probably going to be on the right side of things. So what's happened over the last couple of weeks is actually interesting. We came off about 5.5% from the high, the last time we made a new all-time high, which was the first week in September. From there, we dropped just under 5.5%. That's the second steepest decline we've had. The most was just a little above that, 5.7%. That was in February into early March. From there, we returned that uptrend. And what was different there was we closed below the 50-day moving average one day, and then we came right back above it. And every day we closed below it, we close back above it the next day. This time is a little bit different, right? We closed below it 2 consecutive days for the first time this year, which shows you how much time the S&P has spent above that smoothing mechanism, the 50-day moving average. What's happened now is we've traded below the 50-day. We have essentially bounced off of the August swing low, which is around 43.60. We've now traded back up to the 50-day moving average. Thursday of last week, Friday of last week, we attempted to get above it. Today, we literally closed almost to the penny right at the 50-day moving average around 44.43. So the challenge I have with this market is, I think if you're bullish, this makes sense. This is like perfect. We broke the 50-day, but we didn't get below the August swing low. The previous swing low has held. We have not made a lower low really that much. If we did, just a one-day thing. After that, we sort of bounced up okay. And now we're on track to retest the all-time highs of 45.50 before we accelerate into the end of the year and have this fabulous raging cyclical bull market that continues onward and ever upward. If you're bearish, you see this as perfectly as basically a perfectly poetic way that the market would trade. We hit the August swing low, we come up and test the 50-day from below. How perfect would that be if we then sell off from there and break below 43.60, finally get below the lows of the last 6 weeks and continue? We push on to the downside. The way that would play out, the narrative would probably include the mega cap technology stocks, which have sold off a little bit, would really have to continue, right? Some of the leadership names that have been holding the market up would have to fail to hold the market up. They'd have to come down. Some of the cyclical rebounds that we've seen on things like materials and financials and energy would have to taper off and come down. Now, the reason why I say that this market is challenging, because either of those scenarios could play out, where it becomes very easy for all of us trying to follow the S&P 500 and follow the trends. Is, I would say at this point, we're sideways. If you look at the last 6 weeks, we have gone nowhere directionally. We've gone above and below that median level, which is around 44.50. At some point, we have to break to new swing highs and get above 45.50, or we break to new swing lows, we get below 43.50. We're about 100 points away from both of those. Whichever way that price breaks, either we make a new all-time highs or we make new swing lows, I would expect the path of least resistance to be in that direction. You follow the direction of the breakout, and that's an approach that John Bollinger taught me and many others over his career. That idea of a lower volatility environment, sort of settling into an equilibrium and then breaking out one of those directions. So a sideways trend is nothing to be afraid of. You wait to see which way the price breaks. That's what I would be looking for on this chart. The fact that we've broken the 50-day, the fact that we broke the August swing low, at least to some degree, to me has me on breakdown watch. And I'm looking to see if we establish a lower high, which would be what the third one of those checks on that list to indicate a rotation more towards bearish. So I net out being bearish on the overall price behavior, given the weakening breadth, given the seasonal trends. But let's let the price tell us what's going to happen. We need to move on to our next segment, sector setup. So we spent a good amount of time on the S&P chart because I think, again, given what's happened over the last week, there's a lot happening. Sometimes the S&P chart is just kind of boring and doing its thing. This is one of those times where I think it really behooves you as an investor to focus on it. Let's continue our journey of discovery here. You're looking at the charts and focus on the 11 S&P sectors. Now, where we usually start with this is using the RRG, the relative rotation graph. It is a beautifully designed visualization by Julius de Kempener, who's one of my fellow StockCharts contributors. Please check out his show called Sector Spotlight. Some of the articles he's written on our website. He does a great job of explaining this methodology in a lot more detail than we're able to do in a little amount of time that we're able to feature it on the final bar. But it is a beautiful way to a very simple and powerful way to illustrate the sector rotation phenomena, right? How these 11 S&P sectors rotate around the S&P 500, which is right at the crosshairs. So there's the S&P, and then you're looking at weekly data, and you're looking at how the 11 S&P sectors are rotating around that benchmark in the middle. So what had been working in a big way, technology and healthcare, you can see both very far off to the right, both in the leading quadrant, showing you that the long-term relative strength has been there, but they're both now rotating southwest, what I call the direction of deterioration. These are sectors that are rotating. The momentum is coming out of that outperformance. They're starting to roll over on a relative basis. And you can see when they're heading southwest, that's how you get to the lagging quadrant. And that's how you are firmly underperforming. Real estate, by the way, has come out of the leading quadrant, also heading southwest. So the three leading sectors in recent months are all sort of in the weakening direction, right? And one of them out of the three already there, the other two getting very close to that weakening quadrant. So what is actually doing the opposite, rotating from a position of weakness to a position of strength? Well, it's the cyclical stuff. Things like energy, financials, materials, industrials are all sort of rotating north to northeast, which is the direction of improvement. These are stocks or sectors, excuse me, that are starting to outperform where the momentum is starting to increase. And when you look at the stocks, if you screen for stocks that are making new swing highs, it's things like DVN and others in the energy sector. It's some of the financial stocks that are starting to bounce higher, especially in the short term, and others that had been really underperforming, where you're starting to see that rotate higher. It's interesting how that fits into the broad macro narrative, where this week you're looking at news from Congress and thinking about the infrastructure bill, the additional spending bills that are all being debated and discussed, the debt limit, the debt ceiling, and how that's going to play out. All of that certainly has impact or potential impact on the cyclical sectors. Right? That whole idea of renewed investment in infrastructure all plays out in these sectors most likely appreciating, in particular things like raw materials, industrials, the companies that would actually be doing that. And the financials are going higher because of interest rates. We talked last week about the chart of the 10-year yield and how that's appreciating, going higher, hitting that 150 level over the last couple of days, and all of that speaks to the strength or the upside potential for the financial sector. So, following those narratives, that's where you'll see it reflected on the chart, sort of rotating back to some of the value-oriented parts of the market. So, here's the thing: what that means for the long term. I think there's certainly a case to be made for long-term continuation or long-term improvement in things like financials and industrials and materials. The challenge is the short-term environment. I think that's where the chart of the S&P relates to what we saw in the sectors. The chart of the S&P is actually choppy. We're at a point in the year when pullbacks tend to happen, corrections tend to happen, which is September, particularly the end of September. We're sort of right at that point. So it is very reasonable. I think my general base case is you continue to retrace, you retrench, you pull back a little bit, and some of those sectors, all of these sectors start to rotate around a little bit, and then you see the reemergence of strength going into year end. That's where the S&P could certainly achieve new highs, and it could be led by some of those cyclical areas that had been lagging a little bit overall and are really starting to reemerge. The short term and the long term, it's always a question of connecting those. Now let's look at the 11 S&P sectors using the candle glance function. This is a great way, by the way, to take a list of anything, a list of stocks, ETFs, whatever's on your watch list. Or like what we're doing is looking at the 11 sectors, put them in a simple chart list and then view the list as a candle glance. And what that's going to do is show you this. It's a great way to sort of look at all of the charts at once and glance around and see which patterns emerge. Now, my charts may look a little different because I've customized the look of my screen. And if you've never done that before, if what I just said does not make sense, there's this little gray note at the very bottom. Click where it says "Learn More," and it'll tell you how to evolve these charts or to customize them to fit your particular method. What I do is look at a 1 year chart with 50 and 200-day moving averages because that's the main sort of time frame I want to key in on, especially looking at all these together. What strikes me as I'm looking at these, preparing for the show today, is how you have some sectors certainly rotating lower, some sectors certainly rotating stronger, and then you have sort of the ones in the middle. What's rotating down? What's breaking down through the 50-day moving average? What's testing the 200-day? What's starting to make new swing lows? The healthcare sector jumps out at me, and the reason why that jumps out is because this is a sector where you've actually seen some pretty decent charts. Charts like CRL and others that have been in long term uptrends for quite some while. Dexcom, RGEN, Thermo Fisher, TMO, MTD, Mettler Toledo. These are all stocks that have been in pretty good uptrends. Some of those are in like medical equipment, medical supplies. A lot of them coming off pretty good today for sure. And so these charts are all coming off a little bit, and that's pushing the XLV below its 50-day moving average. It's a great reminder to take charts like that if you own them, or if you're looking at them, and make sure you have your risk pretty well laid out. Right, at what point would you revisit a chart like MTD that has had a really good string of outperformance, but now starting to pull back a little bit? Right, what level does it pull back to that you agree to revisit it? Also note breakdowns in utilities, breakdowns in real estate. These are all sectors rotating lower. What are the sectors rotating higher? It's energy, it's financials testing new all-time highs. We're going to come back here from the break and look some of the stocks that fit in there. But I'm looking at the chart of the XLF. I'm seeing it testing new all-time highs this week on the jump on rates going higher. Certainly a chart to watch. We need to take a quick break. We'll be back with my next segment, shifting stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using charts. And again, I was taught early on in my career as a technical analyst to focus on price. And you learned how all these other narratives, especially in the early 2000s, when I was learning all about charting and technical analysis, the markets were crazy. We were evolving from a secular bull market phase to a secular bear market phase. We had 9/11, all sorts of crazy period, the tech bubble popping or popping as it were, and a lot of discussion. The people that I met with, the investors that I worked with that navigated those periods well, were the ones that were using a lot of charts, and that's what really cemented the value of charting in my own process. We're going to get to a lot of individual names here in a few moments. A couple quick comments before we do. Number one, we love your questions on how to use technical analysis, behavioral biases and how you manage them, questions on routines, investor sentiment and breadth, and technical indicators, whatever it is that you're running into as you are analyzing your own charts. Email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our YouTube channel. We would love to hear your questions. We'll hope to answer one of your questions on our next mailbag segment on Tuesday's show. Also, do me a favor and go to stockchartstv.com. That is our on-demand platform. It's on our website. It's also on all the app stores. Great special events like The Pitch, our year-end review, our 2022 market outlook, which we're in the planning stages of, all of that great content and all of our great weekly and daily shows. Go to stockchartstv.com or on any of the app stores on your mobile devices. Just search for Stock Charts TV on demand. Want to continue on today's show by doing our shifting stocks segment. So the pattern of Monday's show follows my own progress from Thursday into Monday, where I actually do a weekly routine, same thing every week. Starts big picture, looking at the macro environment, looks at a bunch of sectors, and then looks at individual names. And by doing each of those separately and thinking about how they relate to one another, it allows me to get a pretty good feel for what's happening. And I hope what by demonstrating a piece of some of my approach, it inspires you to think about how you are breaking down charts in your own process. Hopefully, you can find some ways to upgrade what you're doing. We're going to hit on a number of individual names, whole bucket of stocks that are really starting to improve here. And again, what's interesting today, you had sectors, outperforming. So things like energy and financials rotating to the upside. The same day, you have things like technology, utilities, REITs rotating to the downside. And so you have this sort of bifurcated market, things that are rotating up, things that are rotating down. That makes sense given the sort of indecision we're seeing with the S&P sort of clinging to the 50-day moving average. Let's highlight some of the individual names on the move. Within communication services, I'll highlight Fox Corp, FOXA. There are a couple tickers you can use for that. That's the one that I tend to use. This is a group of stocks. This actually hit my new swing highs list last week that I run every week for clients. And we were looking at this chart among many others. This is one that's actually rotating above its swing high. So it bounced off of a high around 39, didn't quite get there around 38.70 or so in June, and then rotated lower, testing the 200-day moving average, now rotating again back up to the upside. I think that breakout clears the way to get up to the previous highs around 44. The RSI just becoming oversold, which doesn't bother me a ton because it's a stock that's emerging from a 6-month base, and that's pretty fair that you'd become overbought given that thrust higher. And it would be interesting to see if that uptrend is able to continue. Within communication services, you have a lot of names that are actually not working too well right now. So stocks like this that are rotating to the upside could be worth paying attention to. Within consumer discretionary, it's actually a pretty good sector. And if you look at the XLY versus the XLP, especially on an equal weighted basis, which we highlighted on the show last week, you can see that's rotating certainly more toward the consumer discretionary side. It's charts like McDonald's that come to mind as why that sector is doing so well. This is a stock that overall has been in a pretty decent uptrend for the last 6 months, but the relative strength has been relatively sideways because it really hasn't made a ton of gains on the upside. It just hasn't been going down. Now you're actually starting to see the trend push to the upside a little bit further. We're breaking above resistance from July, which is encouraging, in the relative strength, making a new, we'll call it a 4-month relative high, but close to a 6-month relative high, really starting to improve, particularly in the last couple of weeks. So interesting chart to see if it's able to sustain that breakout above previous resistance. And other stocks in that group, that restaurants group, something like Darden, DRI comes to mind. These are stocks again that have made, bases were in a flat pattern, a congestion pattern for 6 months or so, all starting to rotate and break to the upside. This is another one where you're seeing relative strength that was sort of flat to down and now starting to rotate higher. So I think there could be some opportunities in that group, particularly showing some renewed signs of strength. I think we talked about DVN last week, Devon Energy, and I forget if we did or not. So I apologize if we did not. But this is one of a group of names that have rotated higher within the energy sector. Not all of the energy stocks are breaking out just yet, but they're all certainly showing some short term strength in the last week, bouncing off of moving averages, bouncing off of price support. DVN making a new 12-month plus relative high, price making a new breakout high, getting above the June resistance, and it's not just that stock. There are a bunch of them. We're looking at a couple of E&P names, which are exploration and production, which is a pretty decent size group within the energy sector. And you can see TRGP is another one making new swing highs today, getting above the June peak. Even things like COPS and the mega cap names making new 52-week highs. So you're seeing renewed strength on some of these energy stocks. Certainly, the chart of crude oil demonstrates this rotation from more of a pullback to more of an accumulation phase, as it's testing resistance, if not breaking out above resistance. But I like the improving price and relative profiles in the sector. And if that's a sector you've been ignoring because of the choppiness, because of the underperformance, I think given the strength that you've seen recently, it certainly deserves another look if you're not there or if you've been avoiding it because of the past underperformance. And it's not just that. Some of the other cyclical sectors really, again, starting to improve. Mosaic, MOS, is a chemicals name within the materials sector, again, bouncing off of the moving averages, hitting resistance in August, hitting that same level again a couple weeks ago, and now rotating back higher. All-time highs here around 38, and that's the level, the line in the sand that we're just at. I think a break above that level certainly would be a sign of encouraging optimism for further upside potential. Technology is an interesting one, and semiconductor stocks in general are an interesting space to watch because it tends to be a bellwether group, right? When the semiconductors are doing well, it tends to speak to underlying strength for the markets themselves, right? Because they sort of impact a lot of other things in a pretty big way. TXN is one of the semiconductor names. Now, they're not a totally homogenous group. You're going to find some charts that are working and some not as much within that group particularly. But TXN hit the screen last week as it was making a new 52-week high, again, sort of rotating back above that 195 level. And you'd like to see it hold. The 50-day hold 195 would be ideal. The 50-day around 190 would be sort of that last level. As long as it's able to hold those, it shows this rotation out of this base and pushing higher. So when I think about the market environment overall, and I'm looking at the chart of the S&P, charts like TXN that are able to break out, that are making new highs, that are closing above the open, it certainly shows that there are assets rotating there today and recently. So I've shown you a lot of beautiful charts that are breaking out, that are in strong trends. Why is the market not shooting to the moon? Because the problem is the market is also comprised of charts like Peloton and others that are not working as well. So I would encourage you, if you're ever screening for new highs, looking for stocks breaking out, I would always do the other side of that. Search for swing lows. These are stocks that are sort of breaking down. We'll highlight a number of them just very quickly. Peloton PTON is sort of a poster child, an example of charts that had been working so beautifully. The relative performance of Peloton in 2021 was incredible. The relative underperformance has been consistent from 2021, year to date. And you can see testing the 200-day moving average from below, failing at previous resistance levels, making new swing lows, and again coming down now to the longer term low around 80. That's where we're headed overall, right? We're in a downtrend, and I think that short term weakness could be a sign of longer term weakness as well. Also, I would say if you want to look for stocks that are not working, look at consumer staples. There are plenty of charts in there that are just underwhelming. Something like Brown Forman is not a horrible chart. I mean, it's range bound, but the problem is if you're range bound at a time when the market's going higher, you're just getting killed on a relative basis. It's at the lows, so I get the argument to buying weakness. And if you're more of a mean reversion investor, I could get the argument for why this might make sense. I would much rather buy stocks that are showing signs of accumulation. You're not seeing that yet on something like BFB and other stocks in that group like Mondelez and others. Very, very similar. We don't have time to go through a lot of the healthcare names, but that's the other place where you're seeing a lot of weakness. Biotech in particular, AMGN, ILMN, Biogen, many others really testing or breaking support levels. And I would focus there if you're holding those sort of names and have not gotten quite defensive enough yet. We need to wrap the show here. We need to go to the 3 and 3, three charts in 3 minutes. Here we go. Chart number one is very simply a chart of the S&P 500. As much as we highlight as many different charts as we can, we didn't get too much today into breadth and sentiment because we hit those pretty hard on Thursday and Friday of last week. Just want to remind you when the S&P is at a key level, and I think a lot of people are looking at the S&P, seeing what it does here around the 50-day moving average. I think a really great approach is to think about what levels at which you would acknowledge that the price is broken down. At what level would you acknowledge that the price is breaking out? I have certainly rotated to a more cautious thesis given the breaking down of the 50-day finally after we've stayed above it all year, breaking down at least in the short term below those August lows. I think at this point, what would tell me not to be so bearish, and it would have to be a break to new highs. We'd have to get above 45.50. But I think looking right now at where we're at relative to the 50, this could be a time where we start the next leg lower. This would be about the time seasonally, but also technically where that could make sense. Chart number two is the financial sector. We talk about the 10-year yield and analyze that in a little more detail last week. Just remind you that strength in yields, really the weakness in bonds, the increase in interest rates, the spread of the 2-year to the 10-year, the improvement in interest rates going higher with the 10-year rate testing 1.5% now is certainly a tailwind to something like the financial sector, where that's their business, right? That's their business model is based on that yield curve. So testing new highs, not all of the 11 S&P sectors, and actually very few of them are testing new all-time highs like financials and energy. And I would be focusing on the sectors that are getting it done on a relative basis. Finally, it is a really good time when you have something like MTD, medical equipment, supply names, biotechnology names that are breaking down. Healthcare has been a fantastic sector at times in 2021, and certainly the strength over the last 6 months has been impressive on charts like MTD, breaking down through the 50-day in a significant way today. All it tells me at the very least is make sure you have a good risk assessment. At what level would you revisit something like MTD? And I would make that decision now before it loses much further. Decide what you would need to see. That is our show for today. Thanks so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.